Good afternoon, everybody. Welcome back to the Opportunistic Trader. We're now joined by Vince Lanci. It is December 14th, and Vince is going to be talking to us about trading volatility, options, a lot of different interesting ways he's looking at the markets. A reminder, Vince has been trading for over 30 years, has a lot of great experience. He talks to us regularly in the morning during the gold fix, talking about metals and macro opportunities. Here's Vince.
Hey guys, I'm in the process of putting together a beginning traders webinars. So what you should be seeing on your screen or in the chat right now uh, is a slide, and that slide is titled "What Moves Price." Now, this is a beta situation. The idea is to do this live with video as well as having people to ask questions. But I wanted to do a test run on this, and at the same time give people some good information in a much uh, uh, less rambling sort of way, discuss the very basics and terminology for options trading, using graphs that are a little bit different than we used before, and using something that looks a little bit cleaner than what we've used in the past. So the first, unfortunately, I won't be able to take questions, but if you put them in the chat, I'll answer them afterwards in the chat. Okay, so the first slide is what moves price. And some of these slides are not my own, but the content that went with the slides is my own. I'm not using anyone else's content for this. So what moves price? And by that I mean what moves price in the futures, okay? And that's not necessarily what we're talking about here. We could be talking about stocks as well, or what moves versus what moves prices in options. Now, the futures thing is even a little bit obtuse. What they're saying is if you're talking about a commodity, or you could be talking about a stock as well, what moves the price of the future is the price of the underlying. In a commodity, you'd call that spot. In a future on the S&P, on the SPX, you would call that the ES, or the S&P future. So the price of the underlying is what moves the futures. And I want you to forget the word futures and forget the word stock. Everything that an option trades off is called the underlying. That's all we care about, is the underlying. The underlying security, that is the dog that the options are the tail that wag off of it. And what determines the price of the underlying, which is not there? Supply and demand. In options, there are three uh, major determinants for the price of an option. One is the price of the underlying, where it is trading. Two is the amount of time to expiration. And three is volatility. Those are not necessarily ranked in order of importance, they shift. Note at the bottom, interest rates are also something that influences the price of an instrument as well. Their effect is usually minimal and can be neglected. And that's not my word. It should not be neglected. But what we're going to do is we're not moving that parameter. That's called rho for you geeks out there. The effect of of parameters or influences like interest rates are very negligible usually, but never neglected, uh, because if they're neglected or ignored, those small esoteric risks become big risks down the road. So let's move to our second slide. All right. And what we are looking at here now is a risk graph. Now, you've heard Tom and I talk about these before, but I want to give you, in a very clear cut, one example way to look at it. On the right-hand side, risk graphs help us to visualize and understand the P&L of our options, not just directionally, but volatility-wise as well. Components of the graph now and at expiry indicate the approximate value for different points in time. So now is an arbitrary term. So I'm going to put a value on this. The orange line now represents, we'll say, a 30-day option. The at expiry line is the option the moment before it expires. Now, why are these? If you don't understand this, you're going to understand this when we're done. If you do already, just bear with me here. So, an option, we draw expiration graphs because we want to know what an option will do at expiration. Anything before that is less extreme, less of an angle. So, an option has a smoother curve as it goes further out in time. That's the P&L graph, by the way, of a long call. If you're long a call and the market goes up, you will make money. So you have limited risk and you have unlimited potential profits. And your break even is where that line going across crosses. Now, the curvature becomes more of an angle as an option goes towards expiration. And that curvature reflects several things. Not only does it reflect chance of making money, meaning the market is when it's an orange line, the market is more smooth, and you'll see a more what's what I'm looking for, not transitory or transitional, but a more smooth or uh, uh, connected movement from low to high. But at the bottom, when you look at the green graph, an expiration graph, basically an option expiration is a digital option, meaning yes or no. It's in the money or it's out of the money. So the delta is 0 or it's 100 at expiration, which we'll talk about, which gives way to gamma. But what I want you to see is that if you look at the orange line, not only does it give you a P&L graph, it also implicitly tells you that the delta changes as the market goes higher because it's smooth. Think about your trigonometry and your calculus. So the delta when it's at the money is 50, 51, 52, 53 as the market moves because it's a continuous situation. However, an expiration graph is designed for two reasons. One, to let you know that your option at expiration has either a 0 or 100 delta, and two, to show you what your true cost, all cost in, is for the option and break even. So that's it for a call. And how would we make that for a long? Long a call. What's the opposite of long a call? Some people would say long a put or short a put. Why don't we just flip this around and see what we get? Okay, so if you're long a call, you have unlimited possibility for potential and you have limited risk. But if you look at that same graph upside down, and you'll see these relationships are consistent, you'll see that that position is not short a call. That position makes you money when the market goes down. I'm sorry, loses you money when the market goes down and makes you money if the market goes up, but it's capped. So that position is short a put. So for P&L graph purposes, an inverted long call is a short put. So point being, you're trading off unlimited for limited. You're not trading off call versus put. Next graph. All right, next graph is price of the underlying. What happens to an option's value or the delta of an option as the price of the underlying changes? And we're talking about the three things that move an option's value. And as the price of an underlying, I want to start with the call first because it puts a little confusing for people that are beginners and your axes are labeled upside down. So if you're long a call, okay, that little Greek symbol over there, that's the Greek for delta or rate of change, if you remember. How will the value of my position, which is a long call, change if the price of the underlying increases by 1 point? Well, the delta of the call, you can see, uh, has a smooth curvature, not unlike the curvature of the P&L graph. And I'm not saying it's the same curve, but I'm saying it has a smoothness to it. Meanwhile, the delta of the call at expiration, the green line or the dark line or whatever you would call that, uh, is really a very steep sine curve reflecting that it's either a 0 or 100 delta. So it's out of the money or in the money. The delta of the put, the graph above that, it's the same graph. I'm not so sure that I would have used a graph like that because basically it's saying a delta of negative 100 as opposed to positive. It just flips the signs on the left. I think it's a little bit lazy. It would have been better off had they inverted the whole graph and made a mirror of it. Why don't we do that for them? And so it's more consistent. Uh, how am I doing? No, I don't think there's any change there because it's homogeneous both ways. Okay, so reading the terminology, how will the value of my position change if the price of the underlying increases by 1 point? If the delta is greater than 0, the value of the option will increase if the underlying increases. So if the delta of the put is 20, it's not negative 20. People call it negative 20, but it's 20. And that means you have an exposure of 20 deltas to the short side. If you need to call it a negative 20, that's fine. But the value of the option will increase if the underlying price increases. If the delta is less than 0, Oh, I see what they did here. Okay. The value of the option, they're basically talking about deltas can be either positive or negative. So a positive delta option will increase if the underlying price increases. A negative delta option will decrease if the underlying price increases. So they're basically looking at it from a call perspective. But moving on to the next chart. Uh, all right. I like this chart because I haven't seen it before expressed this way. So we're going to talk about it very quickly. Um, how will the time, I've seen more complex charts than this, but this is kind of neat. How will the value of my position change if one day passes and all other factors stay the same? Okay. Every day that goes by, and this is an at the money option. Actually, we're going to call these all options. The market's trading between 21.50 and 22, call it 21.75, even though it's not perfectly in the middle. Look at it this way. The curves you're looking at there are inverted distributions, meaning your bell curve that you see in options, that's them upside down, but it's a reflection of theta. So as time goes to zero, right, the wings, the 2000 put and the 2300 call, they go to zero. This is a reflection of theta, or loss of premium per day. And as they go to zero, as time goes to zero, out of the money options go to zero. But look at the at the money option. The at the money option, which has the most gamma, the most vega, the most premium, just drops off and loses its most premium in the last couple of weeks. That's why you'll see an option that's at the money. We've talked about this before. An at the money option with 100 days left could be worth 50, and that's a 50 delta option. And then the 10 delta option could be worth 10. Well, when the 50 delta option is the day before expiration, it's worth 10. So if it were, so the when it was worth 50, the out of the money option was worth 10. So that would imply a negative value of the out of the money option, assuming that the decrease in valuation was the same for both of them or linear. But it's not. The option can't go lower than zero. So when the out of the money option is worth 10, and it loses that 10 premium one day, the out of the money option is worth a tick. And that's all it can lose. You can't lose more than you've invested. That's the whole point of options. Okay, so let's go with, okay, this. All right, this is a rather simplistic concept, but okay, this is a movement in volatility if all other factors stay the same. It's a very simplistic concept. We've shown more complex graphs than this, but I want you to look at it this way. The green, well, this is an expiration of volatility. Uh, I think that this is actually uh, not correct. Right? Volatility is the term that you use to describe the percentage. Uh, Volatility is a percent number. Okay, vega, or exposure to volatility, is premium. So if you're long an option if you're long one option and it has a vega of say 250, that means for every 1 percentage point change in volatility, that option will decrease or increase by 250. And that represents your orange curve, or the now curve. At expiration, that option has a value of, say, 50, which means it can't have a volatility or vega equivalent, or we'll call that a volatility delta of 250. It has to have a vega of less than 50, or 50 at the most. So there's a rather simplistic but clear explanation of how, if you're long an option over time, and volatility goes over time, the value of that option will decrease. Or if you freeze time and just lower volatility, the value of an option decreases. If you're ever struggling with those two concepts, as different as they may seem, they're really not. The passage of time is like volatility going to zero. So the more time there is, the more premium there is. The higher volatility there is, the higher premium there is. There's that's a very good way of not confusing it. If an option is worth 20 with one day left, you say, oh, that's got a lot of volatility. That's high volatility. If an option is worth 20 with 1 year left, you say that's low volatility. And conversely, you would say if an option is worth uh, one with well, you get the point. It has to do with time versus volatility, and they're really the same thing. One is a measure of premium over time, and others measure of premium over volatility. Volatility and time are intrinsically related. All right, next, volatility itself. We're going to get started on that in a little bit. We're going to talk about historical or real volatility, and we'll talk briefly about implied volatility. So, historical volatility, you'll often refer to it as realized volatility, real volatility, or just volatility. Historical volatility, they call it historicals because it's the volatility of the underlying over a period of time in the past. So that's the history of the volatility. So historical volatility measures the speed at which the price of an underlying asset has moved over a certain period of time. It does not predict, it shows what has happened. You'll see these, the types of tools that you can, if you're a technician, you can see this in things like Bollinger Bands or Keltner channels and things like that. Basically, it's a measure of the market standard deviation. It's not implied volatility. And we'll get into what implied volatility really is in a second. All right, so for those interested in math, which I am, but we're not getting into the math right now, no worries. We are traders more interested in the application than definitions. This phrase, I didn't write this phrase. You do not have to know how to build a clock to tell time. Maybe that's a straw man argument, but you don't have to know how to build a clock to tell time. But when your clock breaks, if you don't know how to fix it, you've got to call someone else. So every trader should be a risk manager. So you work with clocks. You, for a living, you tell time. Your clock breaks. You better know how to fix it. Your clock is lagging. You better know what the risk could be. Maybe there's dust. If you're a trader of options and you're not interested in the concepts behind that go into them, then you're a tourist and you're a retail person who's going to lose money. And if you make money, good for you. But over the long run, you'll be the guy at the craps table betting hard fours and miscalculating the odds. So you don't have to know the math that's shown here, square roots and all that stuff. But just know this. Just know that the more you know about what goes on inside your clock, the more quickly you can identify what's wrong with it if its time is off. Uh, uh, as a person who used to ride motorcycles, that was a lesson I learned the hard way. I did a cross country ride and really didn't know much about my own motorcycle maintenance and had to learn quickly. The point being is I didn't know there were no motorcycle guys to help me out. I put diesel in my gas tank. And well, that was a story in and of itself. The point is you should know more than just that you're a trader. Traders are prima donnas. Traders who manage risk are more important. So let's get into implied volatility. So volatility comes in two flavors: historical and implied. What historical volatility is based on, while historical volatility is based on past price, we just said that, implied volatility reflects expectations of market conditions for future price fluctuations. People say that a lot. What does it mean? What future? Well, if you're looking at, and this is important, not necessarily to trade, but to understand what it is you're doing when you're buying implied volatility. If you buy a 30-day option that's trading at 24%, the market is handicapping, or you can sell that option. I don't care what you do with it. But if volatility 30 days out is trading 24% implied, that's the market handicapping that the real volatility or the historical volatility for the next 30 days for the underlying will average 24%. All right, think about that. So I'm going to buy an option with 30 days left in it that's trading 24%. That option, the market, that price is saying that the average volatility of the underlying for the next 30 days will be 24%. It gets even more complicated when you look at an option that has 30 days to expire on a future that has 90 days to expire. We won't get too much into that, except that you see that in serial months. Anyone who trades metals, and I think to some extent grains, understands this. When you trade, say, a March option on an April contract in gold, because the contract liquidity will go from, say, Feb to April, and March isn't really a deliverable futures contract. It may be, but it's not liquid. You're If you trade a March options that's based off of an April future, you're trading the average volatility of 30 days on a 60-day future, the first 30 days. So backing out of that complexity for a minute, the average volatility that you bought in that 30-day option at 24%, it could be zero volatility for 29 days and infinity volatility on the 30th day. That assumes that you're owning the option to expiration and you're scalping gamma or readjusting your deltas all the way. And a lot of people don't trade volatility that way. If you don't trade that volatility that way, you're hurting yourself. If you say, I'm buying a 60-day option at 24% because I think volatility is cheap, the question is, do you plan on owning that option for the duration to expiration? If not, you may be shortchanging yourself on the most volatile part of the period. So there's the lesson in that. Next. Okay, some historical volatility indicators. I think we talked about these already. You see, I use Bollinger Bands a lot. They're historical volatility indicators, but I use them. Uh, I used them initially years ago to help handicap implied volatility when it would regress to the mean. But now I use historical volatility and implied volatility combined for directional plays. But basically, what you're looking at here is a chart of Bollinger Bands. Those are in red, showing a widening of a standard deviation. It's probably a 20-day historical volatility. And the Keltners, which I'm not really sure how they work, but they seem to be channel trading. Maybe it's a wider standard deviation. Maybe it's 3 standard deviations. Who knows? But Keltner channels, yeah. Okay, so there you go. There's a way to visually see historical volatility expanding and declining. Let's say you're looking at a daily chart. That's a daily chart. Then each bar represents one day, and the Bollinger Band typically defaults to 20 days of data, the last 20 days, and it typically the width top to bottom is 2 standard deviations, +2, -2. So it's 4 standard deviations. Moving on from there. All right. Okay. In the markets, implied volatility. I think I actually went through the harder part of this. In the markets, future expectations are more important than the past. Well, yes. It's a nice way of saying past performance is no guarantee of future results. It's a disclaimer within an idea. If traders and market makers think that a large move in the underlying is likely, they will reflect this in their bid-ask prices for their options. And that's true. It does not necessarily mean that you don't have to be trading volatility purely on volatility's sake. You could be saying, I think the market's going to go up big, and so I'm going to buy a call. And so you're betting on, well, I don't want to get into it too deeply, but I want people to understand this. You're betting on a big move. So the option has a 30 delta, but you actually think the market's going to go up in a big way. So you think that option is going to have like a 60 delta. So because you think the market's going to move quickly. You're not saying to yourself, well, Vince, I'm looking at the average volatility over the next 30 days, and I'm going to scalp gamma and do blah, 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 whatever market makers do. You're saying, I'm buying this option because I think the market's going to move up quickly. And this contributes, you can see this reflected in the demand for short-term options, because people who don't trade volatility, but trade quick moves, there's a difference between a trending market and a volatile market, will buy a short-term option. So if traders and market makers in options, if you don't know already, are people who are made morally, if not legally bound to make markets and provide liquidity by exchanges. Now, that doesn't really happen a lot in volatile markets, as Bryn and Mike Korn talked about this morning on about natural gas. And that's because people don't step up. They don't have to. It's kind of like a specialist who was allowed to shut down the market when he had an imbalance. So anyway, traders and market makers, okay, that's fine. Traders will be prop traders, market makers, market makers. Right? Using option pricing models, we can now use this given price to calculate the volatility they used in their expectations. The implies the implied as it is contained in the current market price volatility, which is a lot of textbook work there. Okay, this is an interesting chart, including a picture of myself as I was testing out picture-in-picture, creating a webinar. Implied and historic volatility move in sync most of the time. Implied volatility usually overestimates moves in the market. Love that phrase. Mean reversion for both volatilities. Why don't we start at the bottom? Mean reversion for both volatilities. Yes, that's true. Mean reversion for most things in life that have dynamic equilibrium. Second from the bottom, implied volatility usually overestimates moves in the markets. I don't know if I want to say usually, but I do want to say that implied volatility, see, number one and number two there are not true. Many times implied volatility, considering it's a predictive thing, it's someone predicting the future move of the underlying or how volatile it will be. Frequently, implied volatility leads a move in the underlying. You have to look no further than when you have an earnings report. Uh, the earnings report volatility will implied volatility will go up while the underlying doesn't move. Another classic example would be if we declared war, well, actually we did, if we declared war in 93 against Iraq, and that would be bullish for oil. And then at the same time, the president says, I'm going to release the strategic petroleum reserves. That is bearish for oil. So the market will be unchanged, but implied volatility will be higher. So implied volatility can lead a market, can be a tell. You see people buying calls before a takeover. Implied volatility can be a leading indicator of movement in the market. And then once the market gets going, yes, it can overestimate moves in the market. But it also cannot. Nobody's putting that in stone. Top one, implied and historic volatility move in sync most of the time. Wrong. That's not true. Okay, move in sync. Yes, they're correlated, but they don't move in sync most of the time. And the answer, the example of that is, if the stock market rallies 50 handles, how come implied volatility comes in? So that would not be moving in sync. That would be a market with another aspect to it called skew and volatility and stochastic processes. So that statement is just outright wrong. But we're going to talk about it as if it's right for this moment. Implied and historic volatility move in sync most of the time, assuming it's true for the moment, because it can be true in markets where there is very little skew. The bond market historically has very little skew, as do FX markets. Markets with little skew are very deep, and those types of markets have flat, almost bell curve types of options. They lend themselves very well to Black Scholes. Um, in that situation, implied and historic volatility will move in sync a lot. Sometimes implied will lead right before, sometimes implied will move afterwards, but they move in conjunction with the volatility, the real volatility underlying. So how come? But ask yourself this when you look at something like this, when a retail brokerage firm shows you something like this, how come on a 10 handle move in the lower in the S&P, volatility jumps 2%, and on a 10 handle move higher in the S&P, volatility drops 2%? That's because volatility is not always positively correlated with the direction of the move, although it may be correlated with the move itself. Okay, this is me asking a question to see how much the guy knew, and that was fun. I think he shadow banned me after that. But due to the here we go, mean reversion. Okay, we're not talk too much about this. Warning: due to the fast speed in which markets can drop and volatility spikes, having short delta exposure and volatility can be extremely risky. One reason we don't normally want to have a naked, uncovered delta representative. Okay, fine. So that's basically saying don't be short volatility naked. I'm sure that was put in there after optionsellers.com blew out. But we're not going to go too much into that. The reason I asked the question up there in the corner is, why does implied volatility frequently, what did I say there, frequently go up when stock prices decrease and decline when stock prices increase, which was a reference back to the previous chart. I didn't get the answer I got was not satisfactory, but it is what it is. It's reality. Um, the same good old sell high, buy low wisdom applies to volatility. Volatility can be traded directionally with ETFs, meaning you can buy or sell an ETF that is of itself an asset of volatility. I don't advise it for anyone that I know, for anyone that I talk to, but feel free to do what you want. ETFs have so many problems with them systemically. And I'll throw one at you that's like high end before we get into the granular part. ETFs are frequently more, not frequently, but in crisis times, ETFs will be need liquidity. An ETF on municipal bonds, or I'll give you an example, an ETF on houses, right? To be silly about it, an ETF on houses is giving the promise of continuous price discovery and liquidity. But houses trade in a jump market or in a diffusion sort of situation. How can an ETF trade in a more liquid than the asset that underlying it trades? And that's what happens a lot with ETFs, especially 2 and 3 times levered ETFs. These are not passively managed assets. Don't fool yourself; they're actively managed. If you trade the USO, uh, you are trading an ETF that deals with contango, and that person has to roll that contango. And if that product trades more volume, uh, imagine if an ETF trades more volume than the underlying itself. How do you manage it? If you have 5 million contracts wanted to be bought of an ETF, but only 1 million trade a day in the underlying asset of it, like a muni ETF, you're actually opening yourself up to what's called double jump diffusion, which I don't know much about. I'm learning about it right now. But the point is this: ETFs are great for day trading. They're not something you invest in. Um, and here's a little natural gas question. Indirectly, I'm not sure what I wrote there, but this chart says uh, indirectly volatility indirectly with options. Okay, you're trading volatility indirectly with options. It's actually a good statement. By buying an option or selling an option, you're trading volatility as a component of the options value. The other components being delta and theta and other Greeks. But if you want to trade volatility directly with options, you would get rid of the delta risk. Moving forward, how to trade volatility. Well, there's we're not going to go further than here, and that's where we're going to end it. But I'm going to say that you can trade volatility many ways. You can trade it from the long side, and you can trade it from the short side. You can trade it with unlimited risk and limited reward. You can trade it with limited risk and unlimited reward. You can trade it with unlimited both. You can trade it with limited both. You can trade it with direction bias in mind. You can trade it with no direction bias in mind. You can fade it. You can surf it. You can trade things like skew. You can trade things like wings. You can trade time spreads, which is something Tom likes to do. When volatility pops going into an earnings, he'll sell that front month. Not always, but he likes to look to sell the front month option and buy the second month option because he thinks that the front month option is a little bit overbid. So he'll end up buying a calendar call spread, let's say for 50 cents, and then post earnings it'll be worth 80 cents, which is it takes a little risk doing that, but that's how you do it. So there are many ways to trade volatility. You can trade volatility as its own asset class, or you can trade volatility as a kicker to a directional play. And that's it for now. My name is Vince Lanci. I hope this was as half as enjoyable for you as it was for me, because that would mean I liked it twice as much as you. Anyway, I really hope everyone enjoyed this. This is the shape of things to come with Tom and myself, and we're getting our sea legs on this. And PowerPoint and drawing pretty graphs are not our thing here, but we hope to be doing a lot more of this soon. Again, beginners and professionals hopefully got something out of this. Have a great day. Talk to you later.